The Wall Street Journal is reporting that telecommunications giant WorldCom may declare bankruptcy.
Bernie Ebbers, the former CEO of the only Fortune 500 company founded in Mississippi, will not have to spend another day in prison.
Americans, imagine this. One of our most powerful companies was secretly lying about billions of dollars while the public cheered them on. In 2002, telecom giant WorldCom, once celebrated as a symbol of American success and a Wall Street powerhouse, was exposed in one of the largest corporate scandals in U.S. history. Led by CEO Bernard Ebbers, the company had been manipulating its financial statements to hide massive losses while creating the illusion of enormous profits. For years, billions of dollars vanished through sophisticated accounting tricks, while investors, employees, and the public believed the company was thriving. WorldCom had grown into an iconic enterprise, admired for its aggressive acquisitions, technological innovations, and rapid expansion. Investors were drawn to its seemingly unstoppable growth. Employees trusted the stability of their jobs, and Wall Street analysts consistently praised its impressive financial reports. Yet behind the glossy exterior, a much darker reality was unfolding. The company was essentially a house of cards, built on deception and greed. The deception was carefully orchestrated. Ebbers and top executives exploited accounting loopholes and the public's trust, maintaining the illusion of a thriving empire for years. Even though warning signs existed, the company's culture prioritized image and growth over honesty, discouraging any questioning of the numbers. The scandal was not just about financial misreporting. It revealed a systemic failure of oversight, ethics, and corporate governance in one of America's most celebrated firms. As the investigation unfolded, the full scope of the fraud stunned the nation, highlighting that even the companies considered untouchable could crumble from within. The WorldCom story serves as a chilling reminder that ambition, unchecked power, and blind trust in corporate giants can have catastrophic consequences. You won't believe the lengths some leaders went to hide billions of dollars from hard-working Americans. WorldCom's accounting fraud was staggering, involving $11 billion in falsified revenue. To conceal its financial troubles, the company recorded routine operating expenses as capital investments, transforming everyday costs into assets on the balance sheet. This gave the impression of massive growth and profitability, while in reality, the company was bleeding money at an alarming rate. CEO Bernard Ebbers and his inner circle carefully orchestrated this deception to protect the stock price, maintain Wall Street admiration, and hide the company's imminent collapse from investors, employees, and regulators. The scheme was deliberate and systematic. Senior managers pressured accountants to comply, manipulated internal reports, and ensured external auditors and regulators remained unaware. Investors were lured by the company's apparent strength and rapid growth, unaware that the financial statements they relied on were fundamentally false. Even some executives were shocked at the extent of the fraud once the truth emerged, illustrating how deeply embedded the deception had become within the company. WorldCom also relied on a culture of fear, where questioning the numbers could lead to losing one's job or reputation. Employees, investors, and the public were misled into believing in a stable and successful enterprise, while the company deteriorated from within. The scandal demonstrates that polished reports and impressive growth figures can be dangerously misleading when a company lacks transparency and accountability. It is a stark reminder that appearances alone are never enough to judge a company's health or integrity. The truth finally came out, and the American public was stunned beyond belief. In 2002, auditors uncovered the full extent of WorldCom's deception: $11 billion in false entries on the company's financial statements. This revelation triggered the largest bankruptcy in American history at the time. Thousands of employees lost their jobs, investors saw their life savings vanish, and Wall Street was left reeling from the sheer magnitude of the fraud. Stock prices that had once traded at hundreds of dollars plunged to mere cents in just a few days, leaving devastation in their wake. The collapse exposed the vulnerability of even the largest corporations and shattered public confidence, in corporate America. Blind trust in appearances proved costly for investors and employees alike, prompting regulators to enforce stricter reporting rules and oversight. The WorldCom scandal became a turning point, demonstrating that no company, no matter how prestigious, is immune to deception and unethical behavior. The fallout reshaped corporate governance in the U.S., prompting companies to improve transparency, internal controls, and ethical oversight. The scandal highlighted how ambition, unchecked power, and greed could coexist with public admiration, often with disastrous consequences. The audacity of the fraud, combined with the widespread consequences, forced Americans to rethink trust, ethics, and accountability in business. It also serves as a warning that even the most celebrated companies can conceal deadly secrets behind polished numbers. This is a lesson every American should never forget. Even the giants can fall. Bernard Ebbers, CEO of WorldCom, was sentenced to 25 years in prison, and several executives were prosecuted for their roles in orchestrating the fraud. WorldCom disappeared almost overnight, leaving behind shattered lives, ruined savings, and a deep loss of public trust. The scandal rocked Wall Street, destroyed retirement funds, and left employees facing unemployment in a company they once believed to be invincible. It exposed the harsh reality that even the largest, most respected corporations are vulnerable to unethical leadership and systemic manipulation. The WorldCom scandal directly inspired the Sarbanes-Oxley Act, introducing stricter financial controls, mandatory corporate transparency, and harsher penalties for misconduct. These regulations fundamentally reshaped the U.S. business environment and aimed to prevent similar large-scale frauds from occurring. The scandal highlighted how unchecked ambition, greed, and the pursuit of wealth at any cost can devastate entire communities, while regulators scramble to catch up after the damage is done. Never take numbers at face value. Always question what you see and remain vigilant. Even companies that appear stable and successful can engage in deception that harms investors, employees, and communities. Corporate culture, ethical leadership, and regulatory oversight are critical in preventing disasters, but they are only effective if skepticism and accountability are actively applied. Today, the lessons from WorldCom are more relevant than ever. Investors must be vigilant, critically evaluate financial statements, and understand the risks behind impressive growth and stock performance. Corporate giants can fall, and when they do, the consequences are felt far beyond Wall Street. Awareness, verification, and ethical scrutiny are essential tools for anyone navigating the modern financial world, where deception and greed can still hide behind a polished facade. If you enjoyed this story, make sure to like, comment, and share this video, and subscribe for more insane financial scandals that change the world.